Hey everyone, in this video I'm going to highlight the big steps Dutch Bros is making to achieve profitability on the bottom line consistently. Consistently being the key word because this company has a couple of quarters of positive net profits and then one or two of negative. So it's making big steps towards becoming consistently profitable on the bottom line. So let's go through those details. Starting with in the first quarter, adjusted SG&A, which stands for Selling, General, and Administrative Expenses, was 18.6% of total revenue. That was a 220 basis point improvement from the first quarter last year. Now, what that means is in the first quarter last year, SG&A was 20.8% of revenue. So it was consisting more of the revenue was going to SG&A compared to this year. So that's good. That's what you want to see as revenue grows. You want to see your costs remain flat-ish, and so that creates a spread between your revenue and your expenses, and you're beginning to see that leverage from Dutch Bros. And management saying we expect to see further leverage as our revenue growth continues outpacing SG&A investments we need to support rapid development. So that's certainly good news that not only did they achieve 220 basis points of improvement, but they expect to continue to see that improvement because they're not investing so much in SG&A anymore and revenue is growing. And that's typically what happens most of the time. And if you don't see that, then that's a red flag. That should raise alarm bells because one of the things in SG&A, or some of the things in SG&A, are things like salaries for management, like the CEO, CFO, and all, and the management team, the board of directors. Things like rent for corporate offices, right? Those things should remain relatively flat while revenue grows, right? Those, your rent is not connected to your sales. So when sales go up, your rent stays flat and that creates a margin. Okay, so currently the company is investing in infrastructure and payment processing systems as well as the Dutch Bros app. That's good news because 65% of the transactions come from the Dutch Bros Rewards members. So these investments in the app are a large upfront cost, right? They pay a lot of money upfront to build out this technology, to build out this app. But then as revenue grows, those costs are now they're sunk costs, right? They already spent that money. So then that creates again more leverage on the bottom line because you already spent the money on the app, and then going forward the next several quarters and several years, you start to create revenue, generate sales, and that boosts profitability. Also, in 2022, the company absorbed significant margin impact from the effects of inflation. Inflation was much higher in 2022 than it is in 2023 across the board, right? Materials, labor, everything was increasing much faster in 2022 than it was in 2023. But even through that, the company, even through with some belt tightening, they continue to strategically invest in corporate capabilities to enable growth, right? One of the ways Dutch Bros has invested in their corporate capabilities is by increasing wages. They increased wages significantly, and that is a benefit to the company because now you retain your employees, you don't have as much turnover, you don't have to pay for training, you don't have as much disruption when you're keeping your employees. But at the same time, that's going to have a margin impact initially as you boost the wages up to a level that was higher than it was the year before. Going forward, however, that should continue to make progress towards profitability as well because you've raised wages already. You're probably not going to do that again. You're probably not going to do that again, at least in the next year or two. As labor conditions are easing, right, you're seeing unemployment slowly tick up. You're seeing wages slowly tick down. Wage growth is not as aggressive as it was in 2022. So they're not going to likely raise wages again, at least not for this year. So that can provide benefit as the company moves forward to increase profitability. So again, just a few initiatives the company's undertaking to make progress towards profitability. It's got not too much farther to go in order to achieve profitability consistently. So it's not like they need to make huge overhauls. They just need to make incremental improvements, which I think should get them over the edge here, so to where from now on they can be consistently profitable. Maybe not in 2023, but perhaps starting 2024. All right, but that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.